Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we have Danielle DiMartino Booth, who's the former Dallas Fed advisor and is the founder and publisher of Quill Intelligence. Welcome to the show, Danielle.
Great to be here today.
I want to start by talking about some of the points you raise in your book, which is entitled Fed Up, An Insider's Take on Why the Federal Reserve is Bad for America, which focuses mainly on the markets back in 2008 and what happened afterwards with the lowering of interest rates. Can you give us an overview of what you saw back then and where we are today in terms of financial stability and the actions of the Fed? And why should investors educate themselves on what actually does occur at the Fed?
Well, I think it's important that people have a good understanding of the practical way that the Federal Reserve, any central bank policy, affects their lives, their finances, their decisions on whether or not to save or borrow money to buy a home or a car, for example. So there's a very practical level, but there's also a more overarching theme to the book, and that is to understand that, in my view at least, that the Fed lost its way when it started making monetary policy based on the movements in the financial markets. And that is certainly not what the original intent was to be. The Fed was to be an independent institution that based its policymaking decisions on economic metrics and economic metrics alone, and certainly not those of politics or the stock market.
When you were at the Fed in Dallas, your experience back then, is it very different from how the Fed interferes with the market today? Is it becoming more of a hindrance for markets long term? And if the Fed comes to the rescue every time there is a downturn in the economy or markets, what implications does this have for investors in general?
Well, I think the Fed is increasingly backing its way into a box. You know, we looked recently at what the trigger point was in 2007, 2008, and it was basically a 26% decline in the benchmark Standard & Poor's 500 index that prompted the Fed to initiate zero interest rate policy along with quantitative easing. In the most recent episode, where Powell pivoted away and basically bowed to the will of the financial markets, this was in the aftermath of an 11% move in the stock market. So quite remarkable that the Fed is increasingly willing to acquiesce its control and its independence to the will of the stock market. And not good for investors, to answer your question. Not good for investors, not good for countries.
Let's move on to precious metals. For the generalist investor, a forgotten asset class like gold is still considered an asset that is only needed within a financial crisis or as a hedge against a weaker dollar. The average investor is still not interested in gold or aware that it has been in a bull market since the early 2000s. So has the recent strength in gold surprised you, Danielle? And how do you see it acting throughout the rest of the year and beyond?
Well, you have to put in context the fact that gold has been a splendid hedge, as you rightly point out, in times of economic and financial disruption. 2017 was the year of the global reflation trade, and all countries worldwide, save, if I remember correctly, Malaysia and South Africa, were expanding in 2017, and we had a $2.2 trillion record global run rate of quantitative easing. 2018 was the flip side of that, when the countries one by one started falling like dominoes, and eventually we had a full-on reversal of the global reflation trade, and we're seeing the vestiges of that today, with obviously China being at its slowest pace in any modern day memory, and Europe appearing to be sliding into recession, with Germany leading the way due to the trade war. So I think that right now is a very pivotal time for investors to seek out the protection of gold. I will be the first to tell you that we've got gold in our personal portfolio. And again, it has nothing to do with inflation or deflation threatening at the door, but rather, as you again pointed out, being an ideal hedge.
Excellent. Well, let's talk about a recent article you wrote that gives investors a few clues on how to identify a bear market rally within the major markets. You suggest that at the end of the day, it is still fundamentals that should drive investing decisions, and that this may be a bear market rally for the ages, but that shouldn't imply investors should do anything other than rent it. Can you talk to us about this?
Well, throughout history, and it's ironic that I'm falling back on Federal Reserve uh, research, but it actually started at Goldman Sachs and was continued by Bill Dudley, who ran the New York Fed. But research throughout time in the post-war era has shown that whenever we've had 0.3 of a percentage point increase or more in the unemployment rate off of its lows for the cycle, which we have seen, that we have inevitably landed in recession. And based on that, we have seen many instances of bear market rallies headed into the teeth of recession, which is where I think we're going. And many of them have been protracted. One of them lasted for 5 months, for example. Many of them have been stronger even than the one that we've seen since the Christmas Eve sell-off. And the message is that these are indeed rallies that are great for traders who are nimble and are moving in and out of the market. But if you are concerned about your portfolio for the long term, and or you are looking to retire at any time in the interim, medium term, then you should certainly be aware that, again, these are rallies to rent, not to own.
Very good. So, Danielle, give us a sense on some of the successful calls you've made in your career and why they were successful. Has the framework on how you look at the markets changed throughout your career? And do you feel it's becoming harder to make correct calls for a macro investor? Or does the nature of contrarian investing and betting against the crowd still provide outsized gains? I know one example of a great call you made was in the 2000s about warning against the housing bubble. Can you talk to us about that?
Well, that was, at least in my estimation, housing was something that was pretty easy to see. Maybe it's because I was fresh off of Wall Street and writing about the markets, but anytime you have traders on trading floors joking about 125% loan to value toxic waste, that tends to portend poorly for the securities in the end, especially when they're underlying the largest debt market in the world, which is the US mortgage market. So for me, at least, calling the housing crisis was not a huge stretch. It certainly put me in the tiny minority because of how very unpopular it was to make those same types of calls. By that same token, I will put it out there that I did not. I'll put it differently. I am guilty in my investing life of having fought the Fed. And what that means is that if you cannot appreciate the fact that liquidity is going to float financial markets, then you are going to end up crying tears. And again, that is something that I have learned the hard way, and that is you follow the liquidity and where it takes you, and you have to be agnostic about it, even against the rational, logical message that fundamentals are sending out about investments.
As we begin to wrap up the show today, Danielle, is there anything else you wish to talk about? And is there anything from a macro perspective that you wish to share with our listeners?
Well, something that I have followed very closely that is given short shrift and disregarded, even I would say on a global scale, is that of public pensions. And if there's one ticking time bomb in the background, even as we look at the European Central Bank pushing back plans to raise interest rates out of negative territory into 2020. I think that when history writes the final chapter on this era of artificially low and negative interest rates, that it will be the damage exacted on public pensions that is going to be the most extreme, because it's going to exacerbate what we already know to be a fervent populist movement worldwide, because it will widen the inequality gap even further, taking a toll on our most vulnerable retirees. So it's a subject I write about quite often, and it's something that I would put on my radar screen if I was a long-term macro investor.
Excellent. Okay, well, thank you very much for your time today, Danielle, and we appreciate you being on the show.
Thank you. I appreciate it as well.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?